When we talk about beating inflation every single time, we're really talking about understanding how value is created in a world that's constantly changing. Inflation is not the enemy, stagnation is. Inflation simply exposes whether your capital is positioned in places that evolve, expand, and participate in long-term innovation-driven growth. And over the decades, the investments that consistently outperform inflation are the ones rooted in productivity, transformation, and scarcity-driven demand. When you look at historical market behavior, one truth becomes unmistakable: innovation-led equities have been the most reliable engine of real wealth creation. Not because they avoid volatility, volatility is part of their nature, but because they harness disorder to create new markets. These companies grow faster than the general economy, and as they disrupt traditional business models, they generate cash flows that expand purchasing power far beyond the rate at which inflation rises. Over long horizons, innovation compounds in ways inflation simply cannot keep up with. But beating inflation is not about choosing a single asset. It's about placing capital where the world is going, not where it has been. And that means investing in sectors and technologies that are scaling exponentially. Think about the forces reshaping global industries: artificial intelligence, robotics, genomic breakthroughs, autonomous systems, digital payments, energy transformation. These aren't trends, they are platforms for entirely new economic structures. When you invest in assets tied to exponential growth curves, inflation becomes irrelevant because the value created rises beyond the pace at which prices increase in the real economy. Real assets, too, play a crucial role. Land, property, and infrastructure-backed investments historically rise in value because they are directly tied to human demand, shelter, logistics, development. As prices rise, the replacement cost of these assets rises, rents rise, land value rises, construction costs rise, and real assets absorb inflation rather than suffer from it. Their scarcity makes them natural hedges, and their tangible utility ensures long-term appreciation. When combined with innovative companies, this mix creates a portfolio that not only withstands inflation but benefits from it. Then there are commodities and resource-linked assets. They often move in cycles, but during high inflation periods, they help protect purchasing power because the cost of raw materials, energy, and agricultural goods is directly embedded into the economic system. When input prices rise, commodity-linked assets respond immediately, acting as a counterbalance to inflation pressures. Although not long-term compounding vehicles like equities, they provide strategic protection during periods of heightened price instability. The most resilient portfolios are not reactive, they are anticipatory. They don't wait for inflation to become a headline before acting. They are positioned in assets that naturally grow faster than inflation because they are tied to long-term structural changes, technological breakthroughs, demographic expansion, productivity acceleration, and energy transformation. When your capital aligns with forces that scale, you're not trying to beat inflation. You are surpassing it by participating in value creation that inflation cannot dilute. Inflation punishes passive capital. It punishes assets that do nothing, innovate nothing, and grow slowly, but it cannot touch ideas that create entirely new markets. It cannot diminish the value of companies solving global inefficiencies, addressing trillion-dollar problems, and transforming how humans live, move, and consume energy. Inflation barely scratches assets that expand through innovation rather than contraction. The investment that beats inflation every single time is the one that grows faster than the cost of living increases. And historically, that has been a thoughtful blend of innovation-driven equities, real assets, and strategic inflation hedges, combined with patience, conviction, and the courage to invest not where safety feels comfortable, but where growth is inevitable. If you want, I can rewrite this in a more dramatic tone, more storytelling style, or more aggressive financial style for YouTube delivery. Outrunning inflation starts with recognizing that inflation is not just a rise in prices, it is a signal that the world is shifting, that capital stuck in slow, moving or stagnant sectors is losing ground, and that only assets tied to innovation, productivity, and real economic value can preserve and expand purchasing power. Inflation exposes weaknesses in traditional investment thinking, but it also highlights where the true engines of long-term wealth creation reside. The investments that never fail against inflation are the ones that participate in transformation, not tradition. When you study decades of economic history, one pattern becomes remarkably clear. Assets linked to disruptive innovation consistently outgrow inflation because they expand the global economy rather than simply ride along with it. Industries built on exponential technologies, artificial intelligence, energy storage, advanced robotics, precision medicine, digital platforms don't just adapt to rising costs, they redefine cost structures entirely. They unlock new markets, replace outdated business models, and operate on learning curves that drive costs lower as adoption rises. This combination of cost decline and revenue expansion is the antidote to inflation. And that's why innovative equities remain one of the most powerful ways to outrun inflation. They scale faster than inflation erodes value. They compound over long periods because they constantly reinvent themselves. Even when volatility strikes, the long-term trajectory remains upward, fueled by breakthroughs that reshape entire industries. Inflation cannot outrun innovation because innovation accelerates while inflation lags. But equities alone are not the full answer. Real assets, land, property, infrastructure remain foundational in an inflationary environment. Their underlying value rises as the cost to replace them rises. They benefit from scarcity. As the cost of materials, labor, and construction increases, existing real assets appreciate. Rental income adjusts upward, demand for land intensifies, and tangible property becomes a natural store of value. Real assets do not merely respond to inflation, they reflect it. Commodity-linked investments also play a strategic role. When inflation spreads through the economy, it often begins with rising input cost, synergy, metals, agriculture. These are the building blocks of production, and when their prices rise, commodities become direct beneficiaries. While they do not compound like equities, they provide a powerful shield during inflation spikes and complement long-term growth assets. Their purpose is protection, not expansion, but that protection is critical when inflation becomes aggressive. Still, the most reliable strategy to outrun inflation is not a single asset class, it is a framework. A framework built on understanding that the global economy is moving toward higher productivity, driven by technologies that lower costs while increasing output. The investments that never fail are the ones aligned with those forces, companies reducing inefficiencies, creating cheaper and faster solutions, scaling digital ecosystems, transforming energy systems, and building the next generation of infrastructure. These assets grow in real terms, meaning they expand economic value faster than inflation can erode it. Inflation only becomes a threat when your capital is tied to assets that have no growth engine. Cash, low-yield bonds, and traditional fixed-income vehicles are the first to be punished. They shrink as prices rise because they lack adaptability, but the assets tied to innovation, scarcity, and structural demand don't shrink, they expand. They thrive because the world continues to depend on them regardless of inflation cycles. To outrun inflation, you must invest where growth is inevitable, where technological momentum compounds, and where the world's structural needs intersect with long-term economic evolution. That intersection is where real wealth is created, not reactively, not defensively, but through conviction, foresight, and a willingness to position capital where the future is being built, not where the past feels comfortable. If you want, I can craft an even more dramatic U2, ready version, or optimize it further for retention and delivery. Inflation, proof investing demands a mindset shift. Instead of hoping your savings will simply hold value, you place capital into engines of growth assets that adapt, evolve, and generate real economic value even as prices rise. True inflation resistant investments thrive not because they dodge volatility, but because they ride the wave of change that inflation exposes. Over long history, global equities have been among the most reliable ways to preserve and grow purchasing power. According to a long-term study, global stocks since 1900 have delivered average real returns around 5.0% per annum, comfortably beating both inflation and traditional bonds or bills. Cathie International, that kind of compounding power comes because companies grow earnings, innovate, reinvest not just because they passively exist. When businesses disrupt industries, build new markets, leverage technology, and scale globally, their value rises far faster than headline inflation ever can. But it's not just about equities. Real assets, land, real estate, infrastructure have a natural advantage in inflationary times. Property values and rents tend to rise with or even ahead of inflation because they're rooted in basic human needs: shelter, commerce, development. A recent multi-economy study covering 1975-2023 showed that publicly listed real estate firms offered a reliable long-term hedge against expected inflation, with capital value appreciation playing a large role. Springer Link plus one for many, that means direct real estate ownership or real estate. Backed investments provide a tangible store of value, especially when leverage or fix. Trade financing turns inflation into an advantage rather than a threat. Commodities and natural resources also deserve a place in an inflation-proof strategy. When inflation rises, the cost of raw materials, energy, and basic goods often spikes, and assets tied to those inputs tend to respond immediately. Commodities, energy, and resource-linked sectors often rise in tandem with input price inflation, offering a buffer when broader markets wobble. IG plus one, they may not deliver compound growth like companies building the future, but they act as vital shock absorbers, a shield against inflation's sharp spikes. The smartest portfolios don't rely on a single asset class. They combine growth via innovation-driven equities with tangible assets and commodity exposure. This balanced structure helps smooth out cycles. When raw material prices surge, real assets and commodities cushion. When long-term innovation expands economic capacity, equities capture growth. Diversification across asset types, not just sectors, creates resilience, letting you outlast inflation rather than chase temporary safeties. However, inflation-proof investing also demands time horizon, conviction, and patience. In the short term, markets, even solid assets, can wobble. There will be periods when headline inflation outpaces returns or when volatility shakes confidence. But over decades, disciplined exposure to growth companies, real assets, and resources has historically meant rising purchasing power. Ultimately, inflation isn't just a challenge for investors, it's a signal of change. It reveals inefficiencies, shifts value, and tests holding patterns. But for those who invest in transformation, in scarcity, in real value, inflation becomes less of a threat and more of a backdrop. When you align capital with human needs, innovation, and real-world value, you don't merely survive inflation, you harness it as part of a journey toward lasting wealth. Stop letting inflation sneak away with your savings. When prices rise, the value of cash bank deposits, idle money, fixed low-yield investments quietly erodes. What you had yesterday buys less today, but the secret isn't hiding money away. The secret is putting capital to work in assets built to grow, adapt, and expand in ways that inflation can't touch. History shows that equities ownership stakes in companies have delivered real returns over decades, even after inflation is accounted for. For example, long-term studies of stock markets show an average inflation adjusted return of around 6% per year over many decades, driven by growth in corporate profits, reinvestment, innovation, and shareholder dividends. McKinsey and Company +2 Wikipedia +2. When you invest in companies that build, innovate, expand globally, or lead in technology and progress, you don't get a static yield, you ride the growth of economies themselves. This matters especially in times of rising prices. As input costs grow, demand shifts, and economies restructure. Companies with pricing power, innovation edge, and real cash flow tend to adapt and pass on value to investors. That means equity ownership becomes a dynamic shield. It doesn't just preserve purchasing power, it grows it. But stocks alone are not the whole story. Real assets, land, real estate, infrastructure, property provide a tangible, durable store of value when inflation bites. Real estate tends to reflect inflation in both rental income and property values. As construction costs, labor costs, and demand rise, the value of existing properties and the income they generate often climbs too. Forbes +2 Chestnut Funds +2. When you hold land or buildings or invest via real estate linked vehicles, you're holding something real, something whose value adjusts to cost pressures that lash at cash or paper investments. This relationship between real estate and inflation has been confirmed by long-term empirical research. Multiple international studies show real estate, both direct ownership and securitized property investments, tends to hedge inflation in the long run, offering a buffer when inflation rises sharply. Science Direct +1 in environments where rent contracts are flexible, where supply is constrained, and where demand remains steady. This hedge becomes even stronger because rents and property values realign quickly with inflation. CrowdStreet +1 Commodities and resource-linked investments, energy, basic materials, raw goods also have a place in an inflation-resistant portfolio. When inflation surges, prices of materials, energy, food, and industrial inputs often climb fastest. Assets tied to those inputs, commodities, resource companies, natural resource funds, tend to rise accordingly because the cost of real economic production increases. EBC Financial Group +2 EBC Financial Group +2. These aren't growth engines in the same way as disruptive companies, but they are effective shields providing liquidity, tangible value, and diversification at times when inflation shocks ripple across markets. A portfolio that blends growth-oriented equities, real assets, and commodities/resource exposure becomes more than the sum of its parts. It behaves like a well-rooted tree. The equities are the branches reaching for the sky, capturing growth and compounding returns. Real estate and infrastructure are the heavy, stable roots, grounded, tangible, resistant to the storms of inflation. Commodities and resources are like a protective bark buffering against sudden spikes in prices across the economy. That's the core of smart inflation-proof investing, not putting your eggs in one basket, not banking on fixed income returns or cash savings that lose real value over time, but spreading capital across assets that come with inherent growth, scarcity, utility, or input price linkage. Over time, that allocation isn't just defensive, it's generative, because inflation doesn't just erode, it reveals. It reveals which assets are dynamic, which are real, which are aligned with how the world really works. And those assets have a way of coming out on top, not by accident, but by design.